Do stock dividends affect retained earnings? Have you ever wondered how stock dividends influence a company's retained earnings? This topic is essential for understanding financial statements and the statement of retained earnings. Let's break it down in a straightforward way. When a company declares stock dividends, it indeed affects retained earnings. Specifically, the balance of retained earnings decreases. This happens because the company reallocates a portion of retained earnings to common stock and additional paid-in capital accounts. While retained earnings drop, the total stockholders' equity remains unchanged. This is because the increase in common stock and paid-in capital offsets the decrease in retained earnings. To understand this better, let's look at what retained earnings are. Retained earnings representing the accumulated profits that a company has not distributed as dividends. When stock dividends are issued, the company gives additional shares to existing shareholders based on the percentage of shares they already own. The value of these new shares is deducted from retained earnings. For instance, if a company declares a 10% stock dividend and the market value of the stock is $50 per share, the total market value of the new shares issued is taken out of retained earnings. The accounting entries for stock dividends involve debiting retained earnings and crediting common stock at par value. Any excess value is credited to additional paid-in capital. This shows the movement of equity from retained earnings to paid-in capital accounts without any cash leaving the company. From a tax and accounting standpoint, stock dividends do not create an expense on the income statement. They do not impact net income either. Instead, they representing a distribution of equity. While retained earnings decrease, this distribution is in the form of additional shares rather than cash. This means the company keeps its cash while increasing the number of shares outstanding, which can dilute earnings per share. Practically speaking, stock dividends signal to shareholders that the company is rewarding them without tapping into cash reserves. However, the reduction in retained earnings means less accumulated profit is available for reinvestment or future cash dividends. The issuance of stock dividends also influences financial ratios and the structure of shareholder equity, which is important for tax reporting and financial analysis. In summary, stock dividends reduce retained earnings by the fair value of the shares issued. The decrease in retained earnings is balanced by increases in common stock and additional paid-in capital. Overall, total stockholders' equity remains the same, cash flow is unaffected, and net income or expenses are not impacted. The accounting treatment reallocates equity on the balance sheet, reflecting a distribution of earnings in stock from rather than cash. Understanding these dynamics is key for anyone looking to grasp the impact of dividends on financial statements.